Hello, welcome to this very special conversation. As we wrap up this year and enter a new year, we talk to Rashesh Shah. Rashesh, Happy New Year to you, first of all.
I say Happy New Year to you and all your viewers.
I hope we have a fantastic year going ahead, but the last time we spoke, we talked about being in the beginning of maybe a 5 to 10 year bull run. It's been a negative year in the stock market this year. Are you disappointed with the way things are? Do you still believe we're in some sort of a bull run? Where are you, how are you looking at this long term right now?
I think the uptrend is still intact, and I'm not so unhappy with the year, and I'll tell you why. This has been a very bad year for all emerging markets, because I think globally we've been insulated, so we have not realized how bad it has been for emerging markets. But if you were in Brazil or China or Indonesia or Russia or Middle East or any of those countries, most of the emerging countries, the markets have been brutal, the currencies have fallen a lot. So compared to that, we also unfortunately or fortunately are an emerging market. I think we have got away with it a lot easily for two reasons. I think one is the oil price fall has been it's been a completely windfall gain for India, and India has been the biggest beneficiary of the oil price fall. So this oil price fall insulated us in part. And I think the second is our economy is doing well, and especially household savings have started coming into the market, and that counterbalance the FII flows which have gone out a little bit. So the absence of FII flows or the outflows of FIIs counterbalanced by Indian flows, and largely because the economy is doing well, because inflation is down, your real interest rates are positive. All of that has resulted in households coming back to the market.
So when we go into 2016, are you expecting more of that to happen? I mean, for mutual fund businesses at least, it's been a heartening year. We've seen money come in, we've not seen money go out as much. It seems like the domestic investor is ready now to take its place in the stock market. Are you expecting that to continue?
I think it will continue. In fact, it will increase as we go along. And for me, that is one of the biggest, after oil price fall. Oil price fall is done, it's in the price. The biggest factor driving Indian markets is this entire financial savings of Indian households coming into all financial assets. To give you, the historical background, India's overall savings have been between 30 to 38%. We are closer to 30, which means our savings rate itself is at the lower end of the range that it has been in the last 8-10 years. On top of that, household savings as a percentage of GDP has always on an average been about 12 to 13%. We went down to 7.5% in the last couple of years. We are now at about 8.5 or 9. So we are still closer to the lower end of the financial savings as a percentage of GDP. I think it will go back to 11, 12 at least, which is the norm. It has been the norm for the last 14, 15 years.
But in order for that to happen, we'll have to see hikes in salaries more. No, we will see it happen with the pay commission that kicks in January. But in terms of private companies, we haven't seen corporate numbers show us that kind of buoyancy of things are improving. Are you happy with what you've seen on corporate numbers?
See, the savings are already there. Our GDP to savings is already 30%. Household is about 25 out of that 30. So the household savings are there. They are not, whether salaries go up or not. Because to answer your question about salaries, even if the compensation packages are not going up, salaries are not going up, inflation is down. Inflation is down way. So that gets compensated in that. People are not spending as much because I think there is still a lot of uncertainty, and the last few years are still, because I don't think people have said inflation is down forever, and hence I think people are still very cautious about it. But if inflation is down for a reasonably long time, if oil price stays here and RBI continues the good work they are doing, I think a year down the line, households will feel that maybe inflation is down and will start spending again. Though in the last couple of months we have seen spending starting to happen, so maybe that is a good news on that front. The other thing I always believed, and I think we spoke about it in one of your earlier interviews, equity investing is about optimism. And we need Indians to feel optimistic about India again, which I'm hoping will happen in 2016.
Right. If we're talking about the optimism, then obviously when the new government, it's hardly a new government anymore, it's been around for nearly 2 years, but there was a lot of optimism that came in with this government. There is a lot of disappointment that's coming in right now with the fact that not much happened in the winter session, that we're now going to have to look at maybe early next year, the next session. Are you still optimistic? Are you disappointed with the fact that we've not gotten GST done yet? Or where do you stand on the whole optimism scale?
I think I'm still optimistic, and I'm not unhappy with the performance of the government, because you know, India has certain constraints, and what was a good thing, the oil price fall, was also a bad thing, because it took away a sense of crisis, a sense of urgency, because the moment oil price fell, a lot of the macroeconomic parameters fell in
sort
place.
Of eased off, yeah.
So all the pressure eased off, and it allowed the there not to be a sense of urgency, or a sense that we need to resolve and reforms and all of that. Everybody expected, given the given the election mandate that was there, that this will be an aggressive government. They will do things with a big bang. There will be impactful stuff that will happen visibly. What we are seeing is what you call disappointment, is because that has been absent. But I think bit by bit, like they have actually started putting programs in place, and they've done stuff. If you recount them, I think one by one, a lot of stuff has happened. They have avoided doing something that is big bang, which in India, because anything that is very big bang and impactful, like GST,
yes,
it attracts all the opposition. In fact, I always believe that if you hype up a particular reform, it will not get done. The best way to do reforms is not to hype it up, and basically do it very quietly, subtly. If all the media stops speaking about GST, I think GST will get done.
Okay, so then it's up to us to stop talking about GST. There was this other theory that because we're seeing what seems like a long-term slowdown for commodities globally, that over a period of time, so while we tend to enjoy, the oil price crash, let's call it a crash, in India, over a period of time, it will start to impact our economy as well, because a global commodity slowdown will eventually lead to a slowdown for our economy. Is that something that you buy at all, or do you think that that's a baseless?
No, because see, India is overall a commodity importer. We are not. We also export commodities, but on balance, we are a commodity importer. So when commodity prices are low, it is a benefit to India, and that is there are some other things like the investment flows from the sovereign wealth funds in the Middle East will slow down, and those, I think, ancillary things are always there. But on the whole, I think India is a beneficiary. In fact, India is a very strange economy in that sense, that when the world slows down, it is good for India. Though it does affect our exports and other parts of our economy, on the whole, when the world slows down, commodity prices come down, and that always benefits. India is always inversely correlated to the world, which is a good thing about our economy, because that is why in the last 1 year, where the world has not been in a good place, global growth has been affected, global trade has been affected, India still is a bright spot in that sense.
Let's talk about the average retail investor at this point. If we were to put everything we just talked about into perspective for our bank accounts, and if someone walked into your office today and said, please tell me what I should be doing at this point. Should I be buying equity? Should I be putting money in debt? Should I be buying real estate? What would you recommend for the beginning or the first 2 quarters of 2016?
Fortunately, equities have corrected in the last 3-4 months. I do think that around this index price, I think there is a lot of value in the market. Of course, in individual stocks, you have to buy, because there are stocks which are always overvalued and stocks which are undervalued. But I do think for a 3-year, 5-year investor, there is a lot of value in the market as of now, in the equity markets. I also think interest rates will come off in the next year. So even buying bonds or fixed income, especially tax-free bonds, are a great one for an individual who is paying tax on his investments.
Sure.
So things like tax-free bonds, equities, even normal bonds, I think all these are good
So for
investments.
the average 30-year-old investor with a long-term horizon, so that person has at least 10-15 years to go, what sort of asset allocation would you recommend at this point?
I think first, if you're 30-year-old and you don't have a house, a part of your objective of your investment philosophy is to be able to buy real estate for a house. So I think real estate also, there are 2 parts to it. One is real estate as an investment, but real estate as your own house.
Sure.
And I think real estate as your own house is a great investment for everybody. Everybody should invest in that. Real estate as an investment is good sometimes and not so good sometimes. Currently, I don't think real estate is a great investment from the kind of returns it will provide, because the last 5-6 years have given hyper returns, so they'll be normalizing that will happen over the next 3-4 years.
But you always say to go counter-cyclical, and that would mean that given where the real estate market is right now, it would be a good time to pick up something at value, right? Because the market is subdued.
If you're going to use it, because if you're using it as an investment, maybe the next 2-3 years you might not see the returns that are still expected, or the returns that you will get from equity or other investments. So I think equity, and given the liquidity profile and all that, I think equity and bonds will be a good place for a 30-year-old now. But if you're a 30-year-old and you're planning to invest over the next 50 years, you should have some kind of an asset allocation, which, as I said, should have some real estate in that, at least for a housing point of view. And overall, ideally, you should switch between how much allocation to equities and bonds, because those should be the core allocation that you have.
That it's a good time to access the equity market. When we come into this market at this point, would you recommend using mutual funds or attempting to pick stocks directly?
See, you should invest part of your portfolio in large caps, and when you buy the large caps, you can buy them on your own, because usually the risk of any company blowing up in a large cap, which has been around for years and now has a market cap and the liquidity and the governance and all. So what I recommend is, if you have the time and the inclination and you are really interested, then you can do the large caps on your own. However, there are a lot of the small caps and mid caps who also give you good returns. But usually the problem is, 2 out of 10 mid caps will blow up or will have corporate governance issues and all, because that's also much higher risk arena in that sense. So the ideal strategy is, if you want to be also hands-on in your investing, buy the large caps on your own and invest in the mutual funds for the mid caps and small caps.
What split would you advise someone to have? Let's say moderate risk, 30-35 years old.
I think at this current time, I would say 2/3 into mid caps and 1/3 into large caps, because the large caps have actually run a lot faster. Their growth is slower, and if the economy is improving, we are seeing a lot of value still in the mid caps, and that has been happening in the last year. If you look at the mid caps, have outperformed the large caps, because in an up market, the mid caps will give you a lot more bang for your bucks. And also it's an inefficient market, as I said. No, every individual can access it, so they have to invest it through mutual funds. So mutual funds have that advantage. However, there are a lot of investors who like to buy small caps on their own. The excitement of buying a small cap at 18 rupees and 20 rupees and see it go to 100 rupees is undeniable.
Right.
So a lot of people, but for that you have to be willing to do a lot of work yourself, and you should...
And willing to take the hit in case it does
Exactly.
happen.
Exactly. So there is a lot of excitement in investing in mid caps and small caps on your own. But if you want to keep the excitement away, and hopefully you have other things in your life that give you a lot of excitement, I think accessing funds is a good way of doing it.
If we talk about sectors, and you did mention the fact that the RBI is now in a position where they can consider further rate cuts, and the governor has told us as much. Would you then recommend banking stocks, or do you recommend other stocks that are linked to interest rates at this point for the new year? What sort of sectors are you looking at within Edelweiss?
I think it will be very stock specific, because not the banking sector as a whole, for a couple of reasons. I think one is, a lot of banking stocks are still fairly valued.
Yes.
And we are seeing a lot of change in the industry happening, because when interest rates come down, usually banks' earnings come down, because their NIMs, what is called the interest spread that they get, collapses, because their advances get priced down, but their deposits are still sticky. So I think the banking industry is undergoing a change. The ones who are doing well, a few of the private sector banks, are fairly valued out there.
Sure.
So there are some government-owned banks, some of the PSUs, who are currently fairly valued and could have the upside, which are well run, which have a large size. So there could be some value here and there, but it's very, very stock specific. I don't think it's, you can go and say, I will buy banking as a whole. In fact, our general suggestion is, don't be overweight on the banking sector as a whole.
What would you cap your exposure to the banking sector at within a portfolio?
I think not more than 14-15%, though the standard has been between 25 to 30%.
We have seen the Indian consumer spend more money, like you said yourself, in the last couple of quarters. Would you recommend now investors consider consumer stocks at this point, or focus a little more on stocks where, that pay commission money is going to be spent, or any sort of money is going to be spent? Are those sectors that you're considering?
I think there are some opportunities in that, especially the stocks which are urban consumption led. But even there, I think the valuations are fairly, I think the problem in India is the obvious ones have already been scored off in that sense. So, and again, it's a function of how much risk you want to take. If you want to make stock market equivalent returns, then you can be in consumer stocks, because as the market goes up, they'll do well. If you want to do something more, then you might have to, find some undervalued stocks which are slightly undiscovered, which is much harder on the large cap side.
Okay. On the small and mid cap side, if we do have the odd viewer who's looking for the undiscovered stock, what advice would you give them? Obviously, there'll be a checklist of things not to do from your book. What would that checklist be?
I would say they should watch. They should watch your channel, because there are a lot of stocks are discussed. But seriously, I think there are two kinds of opportunities in that. One are what we call the contrarian bets, and the other are the undiscovered ones. On the contrarian bets, there are large companies, a lot of infra companies, a lot of EPC companies, which have high debt and very low equity market cap. A lot of them are currently trading at such low prices at 4 rupees, 5 rupees share, a stock price or 8 rupees stock price. Some investors can evaluate those and see they're buying an option, a call option, because 8 rupees you're buying a call option.
Sure.
If the economy turns around and infra companies come back, that 8 can go to 40 or that 8 can go to 4. So on the downside you can lose 4 rupees, on the upside you can make a lot more. So I think those contrarian bets of stocks which are now trading at what is called option kind of a call option equivalent pricing are actually very interesting. So those are the contrarian bets, but again it's a high risk high reward kind of a game. It's not a safe bet approach. Others are undiscovered stocks. Usually undiscovered stocks are in the range of market cap of between 500 crores to 2000 crores. So there are a lot of stocks which are in that range, which have 800,000, 1100 crore market cap, which are mid caps doing well. The companies have been around for some time. They have track record. They're growing fairly well.
Well, the other investment that continues to be a disappointment is gold, and we've had these conversations in the past about how ideally Indians should start moving away from gold. What's your outlook on gold for the year to come, and would you recommend that as investors, as retail investors, we continue to stay away from gold as far as possible?
We have always maintained that gold as an investment is only for sophisticated large investors who allocate part of the money for various reasons into that. For a normal retail investor, gold is a consumption item. It is not an investment item. And if investors buy gold with that assumption, they'll at least enjoy it. Whether it appreciates or doesn't appreciate should be a second objective. The first objective has to be it's a consumption item. You buy it for your wife or your girlfriend and make sure that she enjoys it. But the good thing it's very liquid, it's very hassle free, and I've been saying that for a long time. We are making financial investing hassle oriented and gold hassle free, and that is why people are going more towards gold. Is the hassle freeness of gold.
Is the solution then to bring down the hassles in financial investments, or
Absolutely.
to increase the hassles in gold?
No, to reduce the hassles in financial investing and make it a lot more easy so that people can just buy, without having to sign some 100 forms and having multiple KYCs and all that. I think all of us have spoken about it, but financial investing should not be so much hassle free, especially for smaller amounts and about 40,000-50,000 rupees. So we try to obviously there is a need for preventing anti-money laundering, this thing, and all your black money coming in and all. But those are for larger amounts. I think for smaller amounts, you should allow people to just invest hassle free.
Are we over-regulated? Are we over-regulated?
I think, as I said, we have tried to really fix every problem, and obviously some people will abuse it. If you have, let us say, 5,000 rupees, no question asked, some will happen. Some people will convert cash money into, black into white, and some. But at 5,000 rupees level, maybe the economy can ignore it and allow that problem to be there. And when you catch somebody, then enforce it, enforce the punishment very strongly. Because our enforcement is weak. And we are not sure we'll catch people. We try to have rules which are so cumbersome that out of 100 people, there are 99 people who want to invest in an honorable way also get affected. So all our rules are designed to prevent any misuse, abuse, even by a small percentage of people. But it causes a lot of inconvenience to growth of the market for the straightforward investor. And we as an economy have to become more pragmatic rather than idealistic. I think India is still very idealistic. We want the perfect world. Everything has to be perfect. We expect that from all our, from the politicians, from our if there is a mutual fund which makes one bad mistake, and and something happens, people will say, oh my God. We don't say it's part of the portfolio. Some things in portfolio will do badly. So we don't have that pragmatism in our approach, especially when it concerns the economy and money and all. And I think hopefully we should bring that pragmatism.
A couple of years ago when we spoke, you had a very interesting idea about using debt in a portfolio over the long term to take away risk. You said if it's your retirement money, don't you want a portion of it in a debt-linked investment that sort of takes away the risk from that retirement? Do you still believe that? What portion would you recommend of a retirement should be in a risk-free asset?
If it's for retirement, I would say you should have at least 80% into assured return kind of an instrument, into fixed incomes. But it's also a function of when you are investing. If you're 30-year-old and you are investing for retirement, you can have a much larger equity component, because see, equity does well the moment you go beyond 5 years. But if you want annual income out of that, so if you're 30-year-old and you're planning for retirement or investing for retirement, have higher equity. When you become 60 and now the retirement is there and you need money every month, I would say have 80% in fixed income, so that your cash flow is taken care of.
You also said, of course, when we were talking a little while ago, that India tends to move contrarian to the rest of the world. Is there merit then for the average Indian retail investor, because we can through mutual funds now invest a certain amount of our portfolio overseas to sort of hedge against what's happening in our market? So 10% perhaps in the NASDAQ or the NYSE, is that something you would recommend?
I think it would be great for that. Though I think what will happen is if you invest only in NYSE or only NASDAQ, then you are susceptible to
fluctuations
any volatility
from that,
in that. In fact, I feel what you need is a global, index pool that you can invest in with diversified.
We don't have access
so we need to create those funds. And when I talk to fund managers, they are saying if the market appetite is, they will create. Currently, Indians are hesitant to invest outside of India because especially in the last 5-6 years,
one argument is if you consider the NASDAQ, and most of those companies are global companies anyways. They are businesses that run across the world, although they might be US domiciled companies. So that's the closest then we'll get to sort of getting a global fund per se. There isn't, I mean, on paper there isn't a global fund that we have access to.
There is no global fund. I do think that investors should invest part of the money in overseas assets, because if not anything else, it takes the rupee risk away, because when you invest in an overseas fund, you also effectively hedging a rupee away, and I think rupee has been fairly soft in the last few years, so you're also getting the rupee benefit on that.
We've run out of time almost, but I do want to ask you for your one word of advice for our viewers who've been tracking your advice now for so many years with us on this show. So for the new year of 2016, what would you give us as advice going into it?
I think what I always believe is be optimistic about India's prospects in the future, because if you want to be an equity investor for the long term, you will have to be optimistic, because the newspapers and the media will constantly highlight what is going wrong, and that is part of their job. But if you get swayed by that, you won't be able to stay the course. And equity investing is about staying the course, not be excessively anxious and fearful about the future. Because India will do well and you will grow, Indian companies will grow, they've gone. I think the last 30 years have been fairly turbulent for them, so they have been able to grow. So I think keep your fear under control, be optimistic about that. And lastly, I would say keep your emotions in check. Ideally, investing should be a very rational approach, but 90% of the investors are very emotional about their investments, and that is where all the mistakes happen. So if you can keep your emotions under check while you are thinking of your investments, I think it will be a great approach.
All right. Thank you so much, and I wish you a very, very happy new year.
Yeah, same to you, Faye, and thank you very much.